Ready? Hey everyone, this is Mark Treichel with another episode of With Flying Colors. This is our fourth annual podcast on NCUA's priority letter, and I'm here with Steve Farr and Todd Miller of my team. Guys, how are you doing today?
Doing good, even though it's cold.
Doing well. Woke up last night with a sore throat and I've been sucking on cough drops for a few hours, but I feel good. I might sound a little off though today.
Yeah, so to those who've heard your voice before, they might say, "Hey, Todd's got something wrong with the speaker. It's actually his throat." So I hope we don't ruin your throat for you today. But I always say to clients or credit unions when I'm talking to them that the most important letter that NCUA comes out with is this priority letter. And the other day, when it came out, I don't know why this popped into my head, but I had a vision of Steve Martin in the movie The Jerk when he gets all excited because the new phone books are here. The new phone books are here, and his name was in the phone book for the first time, and he was really excited about it.
He
So I
was somebody. He
yeah,
was
he,
somebody.
he was somebody right there. Exactly. And so I feel a little bit like Steve Martin when this letter comes out. And I think last year I even did some predictions about what I thought would be in it. I did a separate podcast on that. This year it snuck up on me because it came out a little bit early, and we can maybe speak to that. Typically, it's not out quite as quick, and I think we might have a sense as to why. But yeah, so that's it. We've got the priority letter. And guys, just in case somebody's hearing this podcast for the first time, could you give a little bit of your background at NCUA before you ended up departing and changing teams? Steve, what was it that you did at NCUA back in the day?
I always break my career into two parts. The first half of it, 15 years or so, was in the field, predominantly as a problem case officer, overseeing a lot of the worst problems, predominantly in the western part of the United States, including dealing with conservatorships, a lot of special assistance, and those types of and merger packages and those types of things. Then I shifted to the central office and working remotely for the most part for the next 15 plus years and in the division of risk management. And along those lines, many things, including the training of the PCOs, which I really enjoyed. And then later, I ended up writing a lot of regulations, because once you write one and it works and you know how to do it, you get pegged with doing that a lot. And the biggest one on that one would have been the risk-based capital regulation. So that sums my career up.
Very good. And Todd?
I'll break my career down into three parts. For the first third of it, I followed Steve. We were hired by the same person. We were PCOs at the same time, although he did it a lot longer than I did. But I was an examiner PCO for about the first third of my career. The second third of my career, I spent a decade basically as a regional capital market specialist and doing a lot of the training on liquidity and interest rate risk for examiners and writing policy and exam processes back in that decade. That was basically from 2000 to 2010. From 2010 to when I retired in 2011, I was the director of special actions in the Western region, supervising problem case officers and the regional capital market specialists and a few other duties here and there along with that. But altogether, I spent 31 years with NCUA in those three pieces. It was a very enjoyable 31 years.
Yeah, it was. It was. I had a good time there as well. And those problem credit unions, you always learn things, they learn things. And when those troubled institutions can be reborn and get back on the right path, whether it's a camel code improving or whether it's capital improving, that was always fun to be part of. And we all played a big role in some of those. Now, this priority letter is an effort by NCUA to say, hey, here's how you stay out of trouble. And they point out some things here, some trends and different things. But why don't we walk through the letter in order of what NCUA put them? And first up on NCUA's priority letter this year is credit risk. Any general thoughts about what NCUA says here relative to credit risk, and who wants to go first on this one?
I'll hit it up since Todd's a little under the weather and put some general comments out there. The comments in this letter particularly are real generalized, and they basically, if you look at the FPR for the industry, it's just real logical items that they noted that they put out there. And it talks about delinquency rising and the 12-month charge-off ratio rising. And yes, so those are what are happening, and particularly in the area of credit cards and commercial real estate. One thing I did notice is I was comparing credit unions results against what community banks reported, and you end up with all the stuff through Q3. And they have the same thing going on as we do. But I found that one thing really interesting on the credit card delinquency, highly regionalized. And I don't know exactly why. And I would imagine that we have the same thing going on in our credit unions, and particularly it was like the New York region had just a huge problem with credit cards, and I think those could be driving a lot of the numbers. And there is generally we consider that loan losses and credit quality is going to return to the norm. Because we've been outside of normal because of outside influences that have affected ever since COVID, and even going back to 2008. So what is normal losses? And that kind of drives what the allowance thing is. And it's normal is somewhere around the 0.4 to 0.5%. So I think we're going to see that PLL expense return to normal. The only item under there that I am more concerned about is when you look at the credit union system's allowance for loan losses against delinquency, we're running significantly a lower percentage of coverage than you'll see in the community banks. And that could be because of the difference of lack of commercial lending, but it's a pretty large difference. And it makes me a little bit concerned that our credit unions under CECL reporting and maintaining their allowances adequately.
That's interesting. I hadn't picked up on that. Todd, any thoughts on what Steve said or anything you'd like to add on the credit risk side?
I'll add a couple other nuances to the whole thing, and some of this is just the way the credit industry is react to the marketplace and the way they've reacted to NCUA. As we come out of COVID and interest rate risk, our interest rates rose, NCUA really started beating people up on interest rate risk. Credit unions had very significant portfolios of underwater securities. How do they make up for that in earnings? For the most part, the industry has raised their loan to share ratio. You look at loan concentrations to capital, credit cards have jumped from 36 to 50% in net worth. Real estate loans, and you would assume with the rising rates that real estate loan portfolios wouldn't be growing. But relative to capital, they've jumped from 270% in 2021 to 342% today. That's a big shift in concentration risk right there. Auto loans have stayed the same. For the first time here in September 2024, commercial loans are now exceeding 100% of net worth across the industry. In response to the agency beating them up over interest rate risk and their need for earnings, credit unions have expanded their loan portfolios, and so their concentration risk has crept up on them. And to see credit risk here as the first supervisory priority, it absolutely has to be out there. I think economic conditions have created this whole situation where delinquency and loss levels are rising, and the industry has increased their concentration risk, especially in that real estate, commercial, and unsecured areas. Car loans have stayed relatively the same, but delinquency and charge-offs have really spiked with that unsecured. And while we don't see losses in the real estate loan portfolios yet, or the residential real estate loan portfolios, those delinquency levels have pretty much doubled in a couple of years. They're still pretty low at 70 basis points, but they're still doubled in the last couple of years. So they will be interesting to see how that plays out. I noticed just in my local market, and I don't know how many other markets are, I get a lot of emails from Zillow just because I looked when my son was buying a house, but I haven't seen this before. But in the last 3, 4, 5 months, you're seeing price decreases on homes that were listed for sale, and that is something, at least in our local area, I haven't seen for several years. And all of a sudden, you're seeing it now, right when real estate delinquency is going up and things of that nature. And NCUAs, they do talk about interest rate risk. We went until September of this year, the yield curve was inverted for 790 days. It makes challenging situations for our credit unions, and they're still sitting on a lot of underwater securities. And really, Fed funds were inverted compared to treasuries right up until the middle of last month. So almost 2.5 years. Hopefully a flat yield curve, it will give credit unions a chance to maybe adjust earnings. I think overall they've reacted well to the conditions that we're throwing at them, but we'll see.
It's interesting too, the real estate to capital and the concentration risk going up as you described. As you said that, I did a word search and NCUA references concentration risk 3 times in the letter. We've seen concentration risk hit hard in a lot of credit unions recently, but to see some of those numbers peaking up, I could bet that if a credit union is listening and they are getting hit on these concentration risk percentages similar to what the collective industry is getting hit, that they may see some things in their examination relative to that. We've got some podcasts that talk through that you can go back. If you go to our website and type in concentration risk, you'll get a podcast that will pop up on that. And if I remember, I'll put that in the show notes. I'll also say that NCUA under credit risks has 1, 2, 3, 4, 5, 6, 7, 8, 9 links to other sources. They link to the examiner guide. They link to the commercial real estate loan accommodation and workout letter from '05. They link to allowance for loan loss letter from '04. They link to a home equity line of credit letter from '08. They link to concentration risk. That's one of the 3 links to a letter from '03 and 4 other letters that go as far back as '01 on credit union loan charge-off guides. I didn't test all these links. I'm hoping they work better than the links work in their examiner guide. Sometimes those take you to dead links, but I would bet 100% of these work if they're tying it to this letter to credit unions. But while the letter is shorter, they have a lot of hyperlinks that provide good resources, but are also incorporated by reference. Another general thought, I did that word search, credit or concentration risk came up 3 times. I looked back at the letters the last 2 years. 2023, there were roughly 3,000 total words in the letter, and about 15% of that related to credit risk in a paragraph or 2 or a category of credit risk. Last year, there were 350 words in the credit risk section, but the letter itself had shrunk by 500 words, so it was up to 20%. This year, the letter has about 650 words in 2 different categories on credit risk. So about 1 out of every 4 words in this letter are devoted to credit risk, which kind of gives you a hint at really where they think their problems could be coming from, where credit unions' problems could be coming from. And oh, by the way, they have it listed first, and you should have your top priority first. So that all seems to be congruent. Any thoughts relative to what I added there, or should we move on to the next topic?
I just thought it was interesting that they put a 1991 letter about interest rate adjustments on ARM loans. We just went through a 2-year period where rates went up. Now they're going down again, and they throw this in. And, you on your surface, you might think that doesn't make sense, but I do know in my career, most of the time when we've made credit unions go back and audit their interest rate risk adjustments, it's always failure to adjust them back down. Is where most of the problems were. The problems went both directions, and quite often when you'd have a credit union audit, they would have errors both ways. But it is interesting that they throw this old thing in there from 1991. They're telling you, hey, watch rates as rates fall. Make sure you're adjusting those arms down. And I don't know who thought to throw that in there, but it's interesting that they threw it in there. And it's probably someone that's been around a long time who's actually went through a cycle like this. So I thought that was an interesting ad.
One of the old timers. And I guess the reason I'm glad you pointed that out, because I didn't catch that. It's the last one listed there, but it's because they changed the way they number it. They used to put the year, apparently back in 1991, they put the year on the front end of the number as opposed to on the back end of the letter. Or am I getting all those, or are all the other ones? Yeah. So I actually flipped it. So the numbers I was citing were from they were the numbers of the letters, not the years. Okay. That's a great catch. Good clarification. But yeah,
and you mentioned links. I didn't check them all, but I checked a lot of them. Most of these letters, the links work, but I did find places inside the links where there's other links that don't work.
Got it. Which that can be hard to track, but they should be able to get
Well,
their
you change
examiner
your
guide.
websites over decades, it's hard to keep that stuff
Yes,
all squared
it
away.
is. It is very hard. All right, so that's a wrap on credit risk. What do we have next? They call this balance sheet management and risk to earnings and net worth. I don't think I've ever seen a bolded headline of that category. We've seen all of those things in priority letters, but not where it's been all encompassed in that. So balance sheet management and risk to earnings and net worth. What are your thoughts, guys?
I think we can break it into, Todd hit on it a little bit. We can break it into the three topics. Number one being basically interest rate risk. And then we can talk about earnings and net worth, but it'll be easier to break it apart like that. My 2 cents worth on interest rate risk is what's happening with net interest margin. It's expected to probably not improve throughout the next year. The prognosticators are saying that there's expecting 3 to 4 rate cuts from Fed funds to end up with 3.5 to 3.75 this year. It will be interesting because with what the political influences could be on that, but there is some additional uncertainty in how that would play forward. I saw a lot of the commentaries about when you have the declining interest rate margin, you'll have the low deposit betas that are existing credit unions and that we're slow to, as an industry, adapt to that, which Todd hit on even earlier. The outlook for interest rate risk is declining rates, and how are we set up to react to that, Todd?
Yeah, I think the interest rate risk piece is still there. It's somewhat interesting because liquidity is talked about in this too, and this is part of it too. During COVID, deposit and liability structures just got really distorted. And even before that, with low interest rates where you couldn't differentiate the rate paid on your regular savings versus your money market versus a CD. When rates started rising, our deposit structure has changed. I think it's actually reverted back to normal, what it looked like in 2007, 2008. It didn't change very much between December of 2023 and September, other than some borrowed money paid down. And people borrowed money here when rates went up because they had a huge amount of securities that are underwater. At one time, that unrealized loss was $2 trillion, and it's still $20 billion of unrealized losses in investment portfolios. Hopefully, the falling rates will allow credit unions to kind of normalize that investment portfolio and improve things along those lines. Maybe people now can take some losses to actually get some adjustments in their yields, or if rates fall, it'll just make those investments a little bit more worthwhile. The industry has been really beat up on interest rate risk over the last few years. And like Steve said, some people were slow to adjust. I think the important thing is people, especially with the CDs and higher rates, adjust quickly this next time around as rates continue to fall. If they continue to fall, I think that's a big question. They're forecasting them to fall. When you have a new party in government, who knows whether they're really going to fall or not. So credit unions need to be a little bit flexible along those lines. They do talk about earnings and net worth in here. It's interesting. They basically put balance sheet management in one category, where historically they've broken this out to interest rate lists, interest rate risk, liquidity risk, and then your whole capital plans. And they've thrown three really, really broad areas into one thing. But I think it boils down to this. They're going to be looking at your business plans, and they're going to be looking at how adaptable are you with tactics if conditions change. And we're seeing this just amongst our clients in the last couple of years. There's been just an increased focus on business plans, and in some ways credit unions get criticized if they're just off a little bit. And it's, conditions are changing quite a bit. They can't really predict that, so there needs to be a little bit of grace there. But at the same time, a lot of credit unions, they need to be upfront about what's in their business plans. And if things aren't working and they're changing things, let's be transparent in how we're doing that and why we're doing it.
All great thoughts. And yeah, they did. I used to say 4 or 5 years ago, I think the first time we did this, I maybe the first 2 times we did this, I talked about if everything's a priority, nothing's a priority. And NCUA has gotten better at scaling back on what they're calling a priority. But like you said, they've collapsed basically 3 categories into this one paragraph. And that could be just because they had a new starting author at NCUA. That could be because the current NCUA chairman said, hey, let's take a little bit different approach to this. Or this could be that the likely incoming chairman, Kyle Hauptman, who should be named chairman of it at NCUA shortly after Trump is inaugurated, it could be that he had a little bit more influence on this. I was quite frankly surprised the letter came out this quick. I didn't know if they would just delay it until Hauptman came on so he could sign it, or conversely, the opposite. It was going to be one of two things. They rush to get it out so Todd can sign it, or they wait and they let Hauptman sign it. Now, Hauptman could go out and start doing speeches to tweak this. He can put his finger on the scale a little bit about what goes on and what he communicates to the executive director and the regional directors, but that gets difficult for the field staff. And I know we have some field staff that listen to this podcast, but this is a kind of a beacon for credit unions to look at, this letter, but it's also something that NCUA staff looks at. So with the administration changing, that could get interesting as we see a pivot there. But I do believe that is why this came out quicker. I think Todd wanted to get done on his watch. But he also was very collaborative, generally speaking, when you compare all the different board chairs and how collaborative they were or weren't. Todd tends to be collaborative from what I've seen and from what I've heard and from what I know when I was still back at NCUA. Any more thoughts on this topic or any thoughts on anything I just pondered there, gentlemen?
No, but as we move forward on that, and we'll look at the comment in the letter is that net interest margins have only slightly exceeded operating expenses. And so I looked at how we compare to community banks on that. And yeah, we're running at operating expenses interest margin, 97%, and that we're just a little bit there. And that same measure in that the community banks have a significantly higher margin there between the net interest margin and their operating expenses. And there's going to be, pressure on operating expenses as they, have been rising more than net interest margins. Is that credit unions are, going to be looking at having to deal with their systems and how you're going to compete against the fintech. So there's lots of opportunity there, but it's going to require probably significant investment. So that's going to be interesting to see how the industry deals with that.
And go ahead, Todd.
Question for you, Steve. Did you look at fee income from banks to credit unions? Because I know credit unions, their fee income has fallen about 30 basis points over the last 3 years. And that's a big number. 30 basis points is drop in fee income compared to assets. It's the difference between 70 basis points of earnings versus 1%. And so did you look at that compared to our banks? And I didn't really analyze the fee income of why it fell. You can probably surmise that some of it is loan origination fees have shrunk with the rising rates, although I don't know that to be true. I just do know that fee income has been tumbling the last several years in credit unions.
Yeah, I believe it's also been tumbling in the community banks, because right now credit unions that have a higher fee income ratio to assets than in the community banks.
Interesting. Well,
I think
go ahead. I'm sorry. Go ahead.
the short-term impact has been some of the pressure on the supposedly junk fees and the NSF fees that has been out there. So that was expected, at least on the short run. Now we'll see if rates come down. There's an opportunity for refinances, and even though margins may get compressed, there's opportunity there for fee income on the refinance side.
But that is an area too where I think the political change, the Biden administration coined junk fees. They had banking regulators at the White House when making statements about junk fees, which then it was extrapolated into the regulators talking about it. Chairman Todd Harper talked about it, saying that fee income concentration is a concentration risk, even though it's not said that it is anywhere else by NCUA, but he said it so that makes it. But that's the point, that once you have a new chair, he can go out and say things and do things that can calm the nerves down, and maybe there'll be a little bit of a recovery here on that fee income side. The other thing, as you're talking about all those pressures about making money, I've had a few calls with clients. I've had a few calls with prospective clients this week. And the merger is a big theme where there's credit unions that you wouldn't think would necessarily be contemplating merger, are contemplating merger. And then others, I had a conversation with the smaller credit union this week, and they're ready to throw the towel in just because of the challenge of the exam, the challenge of making a profit, and having self-determination where they can actually influence it and make a decision on a merger when they can actually help pick who that is, which is how most of them get done. But you want to do it when you still have ample capital. But the pressures that are out there are real. And I got a feeling that mergers as a percentage of outstanding units in 2025 will probably, they're not going to go down, and that they probably might even go up.
Yeah, most prognosticators figure M&A activity will increase this year. Yeah.
Yep, very good. So, cybersecurity.
Just one last
Go
comment
ahead.
on net worth.
Yep.
There is some new in the banking industry, some new Basel III Accord kind of stuff coming out. It mostly affects really large institutions. It tends to maybe change some of the risk weightings or reduces some of the risk weightings for risk-based capital. So there's a little bit of downward pressure on the amount of capital for financial institutions to hold, but I think that's going to play out this year as to where exactly that goes.
Got it. Got it. So next on NCUA's letter is cybersecurity. Any thoughts on cybersecurity in general or what NCUA said here?
I don't see that ever coming off of this list. It might get higher some years than others, but just the instances that we've had in the last year with some of our large credit unions having security incidences, the whole AI is creating whole new environments of fraud. And you got the regulators going after the big banks over their Zelle and what's happening with fraud losses there and who should pay for them. I just, I don't see this ever not being a challenge for our credit unions. I will just say at the moment, based on our clients, NCUA is still very much let's hold your hands and help you through it. They're not being punitive. They're being let's instruct our credit unions and do our best to make them better. That seems to be their approach to cybersecurity. But from my perspective, like I said, I don't think it's ever going to come off this list. It just seems to be getting worse and more challenging every year. AI comes out, you'd think, hey, can that help us with cybersecurity? It helps the bad guys create more holes in cybersecurity. So it's just a constant leapfrog battle there. So I don't ever see it coming off the list. I do think it's positive that NCUA takes a helping approach to this with their credit unions. They're not beating them up over it. Let's mature our whole information security platform seems to be the approach that NCUA has historically taken and are still taking to our knowledge.
Yeah, I would say what we've learned from people that have experienced problems when you hit that button to, turn on a new application or something for your members, make sure it works. Because if you hit that button and it fails, it's just total misery.
On every level. Yeah.
This is always interesting because it's such a fast moving area that it is even difficult for regulars to keep up because I was reading then about the quantum computing that's coming out. And there's obviously expenses in there, but there are opportunities there to improve items such as fraud detection. And just the more about what your customers want, the better you're able to react to that. But that just shows how fast this part of operations moves.
Very good point. And I think every NCUA board member ever at NCUA, when asked what keeps him up at night, lists cybersecurity as one of the top two or three things. So I agree it's going to be here forever, and it's something you need to, the dollars you spend on it will only go up, and you need to prioritize that, but it is a definite and real risk that all financial institutions and consumers face. Speaking of consumers, consumer financial protection is always going to be on here, most likely as well, always has been on here. Any general thoughts? I know you guys aren't consumer financial protection specialists from your background at NCUA, but any thoughts about what is said in the letter here on consumer financial protection?
I think it's interesting that fair lending has showed up here 2 years in a row. Usually they change these from year to year. but fair lending was in last year's letter too.
Yeah, they've hit pretty hard on that. They've added staff in the budget. I quite frankly thought they'd add more fair lending examiners than they did over the last 2 years. That being said, they've doubled, I think, the number of fair lending exams that they've had going on. But yeah, there's definitely a focus there. That could be something that you see a little bit of de-emphasis, but probably not a quick turn. I think they'll probably do what they were planning on doing in 2025, but by the time the budget rolls around next time, they may de-emphasize that. When we're doing this recording in 2026, that may fall out. I'll just comment on the overdraft program. I've got a recording of a podcast scheduled with Joe Goldberg, one of our team members here at Credit Union Exam Solutions, to talk about NCUA's letter that came out on overdraft programs last month. More to follow on that. Steve, any thoughts on consumer financial protection?
Didn't we have a few publicized instances of fines being imposed on some of our credit unions?
Yes, yeah. NCUA has been, and the Justice Department has been aggressive on a couple of situations, raising some things into the spotlight, if you will, for some situations. And that's also an area I think with the pivot to the Trump administration will probably be de-emphasized.
So I haven't listened to your podcast on overdrafts. I was going to ask you which direction do you think it goes? Because I find the whole overdraft thing somewhat interesting. And while I'm sure there's banks and credit unions out there that kind of abuse it, in general, though, for the most part, overdraft fees actually almost become a service that actually helps their members more than hurts them. It's a way to keep them out of the payday lending and the pals lending and the pawn shops. And it's a short-term financing vehicle, and they know they're getting feed for it. They're still going to use it anyway because they have needs to do so. They might not build up their credit cards because of that. And it's one of those things, from my mind, it seems, well, this is the best intentions in the world, but at the end of the day, it may actually hurt more members than it helps. And
Todd, what you just said is my opinion. I think the attack on overdraft program is whack-a-mole. If you can't fee them here, you'll find a way to fee them there. And there are people that need that, and they'll go to the fees that credit unions are offering, generally speaking, are better off than the payday lending like you described. Now, we haven't recorded that podcast, and that one is going to be recorded next week and come out in a couple weeks. But
so I advertised for
you
you
did.
here.
Yeah, you did. But what you said, I would agree with. And I think and I have to believe, and I do believe that because the administration and because NCUA has focused on this, there have been people and credit unions who've shut programs off and are just bouncing the checks now. And there's rules they need to follow relative to that. So people are being driven to payday lending sources in an environment where where things are inflationary, and it's going to get harder and harder for the people that they're trying to help, in my opinion. So I would agree with that. So other updates, exam updates. I've got a couple thoughts on this, but I'll just read this one. It says in 2025, the NCUA will update its exam flexibility initiative to provide an extended exam cycle for credit unions over 1 billion in assets, where the NCUA rated the credit union a Camel composite or Camel's composite 1 or 2, with no change in CEO since the last exam. These institutions will now be eligible for a 12 to 16-month exam cycle. Additionally, the extended exam cycle for the eligible federal credit unions will be shortened from 14 to 20 months to 14 to 18 months. So they're trimming it 2 months on one end, but they're allowing the big credit unions to have an elongated exam cycle. Any general thoughts on that, what you've seen historically in this area? I have a separate podcast I did on this when they brought this up, when they snuck it into a statement at the board table. But what are your thoughts on that, guys?
I'm sure they're doing it because they can't meet their own exam program, but let's just say they've moved their exam cycles many times over our 30-year careers. And it's every time they extend it, it just doesn't turn out well for them.
Meaning it leads to insurance fund losses in the end, which is what the game is. They end up having more losses because more things can get missed and more situations can go from bad to worse before they go back in. Steve,
Or at least the number of troubled credit unions ends up accelerating and speeding up on them.
Sure. Yep. Yep.
In some respects, I think if this is the thing with all the regulators and it's like cybersecurity, you're reacting to the environment, you're reacting to political situations. It's very difficult for them to get ahead of situations. They're always reacting to things that have went on behind them. So it's
Excellent point. Steve, anything you want to
You know,
add?
this is going to put examiners need to do good on those cases assigned to them on how they're managing their district and looking at, the periodical, actually looking at the reports. Hopefully they're getting, enough budgeted time to where they're going to feel like they get to spend enough time to monitor their district and feel like they know what's going on so they can spot negative trend earlier and react.
Great point. Great point. I'm looking back to try and see the name of that podcast I did on this. It was episode number 222. By the way, guys, we're on about 230 episodes of With Flying Colors at this juncture. But episode number 222, I called it NCUA changes exam frequency, or regulatory theater. Todd, you pointed out that NCUA has had a difficult time doing their exams timely. They've pointed that out in their annual performance report where they put their goals that link to their strategic plan. And Kyle Hauptman, who I've mentioned a couple times here, is going to be the chair, has said, hey, we're not even getting our exams done on time. We're not getting our code 4s done on time. We're not getting our code 3s done on time. I guarantee you, if they're not doing the 4s and 3s on time, that they're not doing the 2s and 1s on time either, because those have less risk. I was talking about this as it happened, and my wife was sitting in here, and she came up with a perfect analogy before I recorded that last podcast, saying that it sounds like what the airlines did when the airlines 10, 15 years ago couldn't get anywhere on time and they were getting beat up in the press that they were always late here and they were always late there. What did they do? They added a half hour or 45 minutes to every flight, and voila, every flight was on time. So this is more, we haven't been doing them timely. We haven't been getting in there every 12 months. So we might as well get the good political soundbite of saying we're elongating our cycle, setting aside the fact that people take forever to get their exams, but they're really just changing their policy to match what has actually been being done for, I would say, 2, maybe 3 years, maybe all the way back to the pandemic. It sounds good. It's a good soundbite. I got some ideas on who in that building might have figured out how they might be able to spin it. When you've been there 34 years and you see the spin, you got to call them on it.
Steve mentioned something about district management for credit unions. And so Steve was a PCO for 15 years. I spent 15 years dealing with troubled credit unions, probably more because a lot of my RCMS time was troubled credit unions. And I'm sure you've seen a lot of this too, Mark. The district, so there's postmortems that NCUA always issue when a credit union fails. And they always say management caused the failure of the credit union, which is true. But what they almost rarely say is how frequently NCUA should have caught things a lot sooner and didn't because district management wasn't there. It's interesting. They've created tons of tools to now examiners have reports like crazy to fill out. They have rate reviews. They have these risk reviews. They have tons of things, but it's still they still don't just seem to catch up on let's catching things early. And I think maybe they've created so many tools that examiners are checking boxes and not really thinking about what's happening in their credit unions. I don't know how the agency fixes that, but when they get to cycles like this, they do need to figure out a way where there's less false positives in their monitoring system. I think their monitoring system creates lots of false positives, so people miss the real important things when they start going south.
Yeah, great point. And when they talk about credit risk and they seem to really be concerned about credit risk, the data's going the wrong way. And then they say, oh, by the way, we're increasing the exam cycle. That's not congruent. That's just not congruent. Any final thoughts, guys, before we wrap? I know there's a category on minority depository institutions, and that tends to be something that's in there under Democrats, and it tends to fall out under Republicans. That's all good language there and things credit unions should do. If you're an MDI credit union, you should take a look at that. There are resources available from NCUA to assist. But any final thoughts on this or any other topics in the letter?
I think it's just a big one. Their number one is credit risk, and that's what causes the vast majority of failures in credit unions. Okay, there's a fraud loss here and there, but it's credit risk most of the time. And really, credit unions. I had a CEO of, I don't know, it was about a $700 million credit union one time tell me his number one responsibility was ensuring that their credit risk was solid, even though that was a large credit union, that person probably never touched loans. He's seen that as one of his key responsibilities. And what we see with clients over the last few years, there's a huge emphasis on getting your concentration risk numbers aligned appropriately with your capital position, getting your whole loan servicing systems in place. If you're a commercial lender, it's not just did you make a good loan today, but are you servicing it appropriately? The NCUA has told credit unions, hey, we're focused on credit risk. Credit unions, you need to make sure your credit lending systems are up to par, collection systems are up to par, credit monitoring systems for all your various loan types are up to par. They're going to be looking at those things, and really for the survivability of your institution, if you're a lender, you need good credit risk management systems in place and a good credit culture. Another member of Mark's team, Vin Veaton, he hammers on credit culture all the time, and NCUA is going to be out there assessing your credit culture.
That's a fact. That's a fact. Great point. Steve?
One thing I was surprised that didn't appear in the letter, because we saw it a lot in some of our clients, is either examiner findings or document resolutions, was the topic of corporate governance.
Yeah, I'm shocked. You got one of you guys had pointed that out before we started recording. I'm shocked that's not here because it is very present in examinations. As you said, when someone gets an examiner finding or a door, it seems to be linked back to corporate governance. Yeah, very surprised it's not there, but just because it's not there, don't expect NCUA to stop asking you about it. We have good podcasts out there, 2 or 3 different podcasts on corporate governance that you should listen to. They will help you with your exams for sure.
Yeah, and Todd kind of hit on it, that whole credit management thing in culture is, what is your risk appetite? Can you describe it and share it with your employees so everybody's on board with what the mission is in terms of a credit culture?
Absolutely. Yep, great point. All right, guys, as always, this is a fun one. Steve and Todd, I want to thank you for being available today to talk about this with our listeners. And listeners, I want to thank you for listening as always. I'll hope you listen again soon. This is Mark Treichel signing off with flying colors.